Hi there, this is Mike Larson, Editor-in-Chief with the Money Show, and I'm coming to you from the Orlando Money Show 2022. I'm pleased to have Michael Lee here, the founder of Michael Lee Strategy. His firm helps with retirement planning, wealth management, and investments. So, Michael, how are you? Welcome to the show.
Good, Mike. Thanks for having me.
Yeah, glad to have you here. Why don't we start and have you maybe give me an idea and give some of the viewers an idea of what it's going to be that you're talking about here and sort of your overall view on the markets, and then we'll take it from there.
Sure. So what I'm talking about here is a lot of people still need to live off their portfolios. And so unless you recently took a lump sum of cash and bought a bunch of fixed income, chances are the yields from your fixed income investments from last year or the year before are 3 or 4%, maybe 5% if you're lucky, and you've been selling some stocks or looking for dividends off those. And so what I'm going to talk about is things that you can take money and invest in now. They're going to pay you high single-digit yields, so that you're not selling these stocks down 70 or 80% to generate money. And then basically where you can hide in this environment. I think we are in such a unique set of circumstances right now, and the economy is rapidly deteriorating. It seems with every month as inflation's picking up, the economy is deteriorating. The Fed is super aggressive. So we are very much in uncharted territories, which it keeps me up at night as to where we're going to go next. I think I have some good ideas to weather the storm, but we'll see.
No, I hear you. I mean, you think about an environment where typically if you got a 60-40 portfolio, yeah, sure, your stocks are hurting, but your bonds are helping you out. Here, it's been tough for everything, real estate, the whole 9 yards. So in that environment where the economy's having issues, the full effect of the rate hikes hasn't really hit yet. What do you see happening over the next 6, 12, 18 months? I mean, where do we go from here?
So I think these next 6 months, I don't know if they'll be like 2008 into 2009, but we're definitely headed towards a severe recession.
Yeah.
So first thing you look at is housing. Housing has started collapsing in April and May, and that's really taking a huge dive. Next thing is manufacturing, so housing and manufacturing are the core of your LEIs, your leading economic indicators.
Yep.
The degree that they've fallen, you've never not had a pretty severe recession after. So the next thing you're going to look at is for earnings estimates to come down. I think the fourth quarter earnings season is going to be horrific. I think guidance is going to continually come down. Year to date, earnings are down if you take energy out of the equation, and earnings growth going forward is negative without energy, basically the year-over-year gain in the price of oil. Yeah. So I think there's some damage and some blood. What I would say though is that the market typically turns right as we look like we're heading into Armageddon. Yeah. So in 2009, the market bottomed in March. Unemployment didn't peak until April of 2010. And so for the longest time, we've been talking about a Fed pivot. I think it's beyond that. I don't know necessarily that the Fed pivot matters the way that it did a few months ago, because the Fed's going to be pivoting because they're always late, because you have this lag effect. It's really hard to predict things going forward. And historically, you want the Fed to raise into strength to slow that down, not to go from 0 to 100 miles an hour, or specifically in this case, what it looks like 0 to 4.25% inside of 9 months.
It's amazing, isn't it? I mean,
after we've been at zero interest rates essentially since March of 2009, like this is a real shock. We don't know how it's going to play out. Plus, you're running $100 billion a year off the balance sheet. I'm sorry, $100 billion a month, 90 to be exact, off their balance sheet into the market. So look, markets might not go down another 30 or 40%. But I see it hard for markets to go much higher in that time frame.
Yeah. When we talked even before the show, you'd mentioned that you feel like this is the time to be the most defensive you've been in your career. So how does that translate into what clients should do, what investors should do? Defensive for you means what? What do you buy? What do you sell? That kind of
So what I would say is if a client has an allocation to stocks, and that's 50% of your portfolio, if you're 40% if you're conservative, it might be a good idea to take that 50 down to 40, take that 40 down to 30 or 35, and you can buy municipal bonds going out 4 or 5 years and get over 5%. Right, that's an attractive yield. You can buy 2-year Treasuries making over 4%. Right, so if you have cash on the sidelines, these Treasuries make a tremendous amount of sense right now, more so than the munis for just cash on the sidelines. Because if the market goes down a third very quickly and you want to get back in, those Treasuries are very easy to sell. And if you buy a 2-year Treasury, and that's 6 months from now, that's only a 1.5-year Treasury, right? So the chances of massive principal loss in that equation, especially because the Fed's most likely to go the other way, so you could make a little bit of money on the principal, while at the same time you're earning over a 4% yield. It's just a smart play right now, and that's that's another kind of destruction of what we've seen over the last 12 years.
Yeah.
Like Tina, there
Exactly.
is no
There's no alternative, but now you have one if you know where to look, right?
So it's so for me in my equity allocation, I have a 20% allocation to cash.
Okay. Okay. Now, within the market, if somebody either has to be invested in stocks or they're looking to just kind of be more defensive, take this down, maybe take this up, what is it, consumer staples, those kinds of things you like, right?
Yeah, so staples, utilities, healthcare, energy
Okay.
are the sectors I'm in right now. So staples, utilities, healthcare, energy.
Okay.
Yeah, that's it.
Yeah.
Those are the only sectors I'm invested in now. I don't own anything else. I own a little bit of the TLT, which is the 30-year Treasury,
Yep.
right? And so in 2000, the last half of 2008, the S&P 500 was down 34%. So from June to December 31st, that TLT was up 35%. So we're going to run a situation where that's really going to start rallying hard, and it's a good defensive play. So
Yep.
for people out there betting in the options market, looking for a trade, I don't know if today's the day, but over the next 2 or 3 months, the TLT is going to go from either 90 or 100, where it is then, to 120 or 130 in very quick fashion as equity markets fall apart.
That's a nice contrarian opinion. Nobody seems to want to touch bonds these days, but sometimes when this kind of economic backdrop and stock market backdrop, where are you going to find protection, right?
Yeah, it's funny. So historically, the long-term correlation between stocks and bonds is like a 0.2, which is why that 60-40 works so well. It seems this year we have a positive 1 correlation, but in times of crisis, you have a perfect -1 correlation between the S&P 500 and the 30-year Treasury. Meaning, so in COVID, when the markets fell apart, that long bond rallied, and you have it in little different patches in different periods of time. When the market's down 4 or 5% over the course of a week, the long bond's up 4 or 5%, right? Because it represents the insurance value of the United States of America. And so that hasn't really worked this year based on what's going on in rates. And I think what's going on in rates is driving stocks and driving the economy. So the Fed, the Fed is absolutely taking us into a recession, but it's you've got to find a way to fight inflation because I was talking to another gentleman here, Kenny Polcari.
Sure.
He's literally the only guy I know that was working on Wall Street in the early 80s. Right?
So he has that experience. You have a lot of other people who just they don't remember what happened back then. They don't know Paul Volcker. They don't know double dip recessions and how interest rates had to move so high to tame everything back then. So it's
so if you're a 50-year-old senior executive at a brokerage firm, a hedge fund, a money manager, you started on Wall Street in the late 80s. All you've known is a bond bull market. These bond bear markets, other than 1994, very few people working in the industry lived through the late 70s and the early 80s. And the story that I've always heard is that inflation's much stickier than everyone imagines, but historically it's been housing, manufacturing, earnings. Once earnings come down, unemployment rises, and inflation is the last thing to fall off. So will the Fed lose their will and stop raising so aggressively, stop raising at all, or cut before inflation falls off, and the anticipation it will come off, with the possibility that they get embarrassed later this year, or are they going to hold pat? So I think we're going to get to 4.5% in the front end, which will be more than enough to kind of crush everything. And the more inflation persists, the more the economy is going to slow. So we're in a bit of a conundrum.
You got to prepare, right? You've got to play for the market that you have, and it's a tough environment. Invest like it, right?
All right. So till then, I'm staying defensive because just when it looks ugliest, the market will turn. And you should never be 100% out of the market or 100% in the market, right? So again, if you're 60% stocks, maybe take that down to 55 or 50, right? Don't get all the way out. And inside that equity allocation, try to get more defensive.
Michael, that's some great practical advice and great perspective. Really appreciate your time here today. And thank you everybody for watching.